The turnaround story for 2022 has been the banking sector's revival. Net profits of scheduled commercial banks were up 40% in the second quarter of 2022-23 compared to last year. In fact, as per Business Standard analysis, the share of banks, financial services, insurance and stockbroking or BFSI in overall corporate profits hit a record high of 41.5% during the second quarter, double its historical 10-year average share of 21.8%. The fact was further cemented by two RBI reports released last week. One of them, the report titled Trends and Progress of Banking in India, showed that banking sector has moved from loss to profit over the previous 5 years. Moreover, the Financial Stability Report showed that gross non-performing assets called GNPAs or bad loans had declined to a 7-year low of 5%. Until 3 years ago, NPAs of scheduled commercial banks were over 9%. Net NPAs in September were at a 10-year low. The RBI report highlights timely policy support cushioned the impact of pandemic on banks' financial performance and soundness indicators. This has been accompanied by lower slippages and the bolstering of capital buffers. But to understand what this means, let's go to our banking editor Manojit Saha.
The public sector banks were having a disproportionate share of bad loans. With the support of the capital from the government, banks were able to make provision for the NPAs. As a result, gross NPAs peaked in March 2018. Since banks were mainly focusing on retail loans in the last few years, new NPA creation or fresh slippages was contained. Now that the provisioning part is over, with loan demand coming back, banks are able to improve their profitability.
Although banks have had adequate capital to deal with the crisis, can they weather the upcoming storm, especially as interest rates rise? More important, can they sustain their performance? While both reports highlight growing risks from rising interest rates and global headwinds, they do point out that counterbalancing effect may help banks sail through. The mark-to-market losses may be covered by the rise in interest margins as most loans are external benchmark linked. The Financial Stability Report goes further to say macro stress tests for credit risk reveal that SCBs are well capitalized and all banks would be able to comply with the minimum capital requirements even under adverse stress scenarios. But can they sustain the current performance?
We have a positive outlook on the banking sector. So even for FY24, we expect ROAs to improve by about 10 to 15 basis point, and credit growth to move from 13 to 15% in FY23 to about 14 to 16% in FY24. But there are some risks that also remain in the system. Few macroeconomic risk is increase in interest rates. If there is some issue in the financial system globally because of that, we could also be impacted. 2-3 other macroeconomic reasons are geopolitical events, global recession, and COVID impact. If we come to risks on the industry side, banking industry specific, then increasing competition and higher share of unsecured loans could be a problem going forward.
The immediate challenge for banking sector is to shore up deposits. Asset quality may not be an issue for now. Banks may be resilient to a crisis, but profitability will depend on managing credit. Can profitability lead to more risk-taking is what remains to be seen. Empirical estimates show that net interest margins need to cross 5% threshold for bank profitability to turn detrimental to financial stability. By end March 2022, the NIM of scheduled commercial banks was 2.9%.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.